All right, recording is started. Again, welcome everyone to today's call. We're going to go ahead and get started. Lots to cover as usual today. Market is moving. One of the worst scenarios that we could get involved in is occurring, and yet we're making money. So we'll get to that here in a second. First of all, I do want to remind everyone, if you have not upgraded your subscription, upgrade to a 1-year subscription so that you can get the massive super discount on the upcoming seminar, which is just going to be fantastic. So call Spring 918-203-7547. Make sure you upgrade your subscription to a 1-year subscription. When you do, you get a massive discount on the seminar, July 31st, August 1st. It's online, obviously, since no one can travel. Basically, I can't even imagine traveling in today's current environment with all the restrictions and whatnot. But nonetheless, it's going to be online. It's going to be live. So I'll be there answering any questions after every session, and it's just going to be a tremendous seminar where we fully cover. I say fully. The more I get into it, the more I'm going to have to add some stuff to it later on because there's just so many directions that this thing can go. But I want to make sure that you're focused on the first thing first, and so we'll add stuff later on. But to begin with, we're going to be talking about the triple play option patterns. We'll be talking about those again today, and we're going to be talking about TPO profit stacking. Profit stacking is a tremendous approach. You got to get through the patterns first. So first things first, and it's something that you're not going to want to miss. Now, for those that are new on the call, I do want to welcome you, but I also want to caution you on several issues. Number one, I don't explain everything about these trades on the call. I can't. There's too much to go over. This is for people who have been attending the calls, who know what we're doing generally. And then if you don't know what we're doing, if you've been on a few calls and you still don't know what we're doing, you absolutely want to attend the seminar. But you're not going to come away from this call understanding everything that we're doing. If that's what you expect, you're expecting way too much because no one else is showing you this stuff. This is brand new for most option traders, even if you've been trading for 20 years. So just stick with us, though. It's only a matter of exposure. The more you expose yourself to this, the more you are going to understand. The second thing that I want to caution you about is that these trades are fantastic. As you're going to see from today, they're fantastic. As a matter of fact, I'm about to release a new video, and the video is called 98% probability of becoming a millionaire. 98% probability of becoming a millionaire. And to most, that would seem like it's hype, but it's not. It absolutely is not hype. And it's because of these types of trades. They are great trades. They're fantastic trades, but you have to start small. You have to make sure that you understand what you're doing. You have to make sure that you understand everything that I've said, because I'll say a lot of things and then people they don't fully understand what I'm saying, and then they do it and then they're like, oh, that's what he meant. And so then they made a mistake or whatever. So start small. There's plenty of time to grow, and I'll get to that here in a second. Number two, you don't want to be reckless with how you put these things together, because there are some traps. If you do not know what you're doing, there absolutely are some traps, and they can cost you big. And then number three, you want to follow the instructions. As I've said about 6 or 7 weeks ago, I didn't follow my own instructions because I thought I knew better, because I thought, no way, there's no, which is the most ridiculous thing. It doesn't matter how many years of experience you have. It doesn't matter how much education you have. If you don't follow the instructions, the rules apply to you. And that's kind of, something that we sometimes don't want to acknowledge, is that the rules don't really apply to us because we have so much knowledge or so much experience or whatever. The rules apply to us. So follow the instructions. You'll be glad you did. Great trades does not mean that you can throw caution to the wind. And why do I say start small? A lot of you have a larger account, 100,000, 150,000, 50,000 even, because there's plenty of time for growth. The way you're going to become a millionaire in trading is through compounding, period, end of story. You're not going to find the next ballistic stock. You're not going to follow some guru who has some magical crystal ball telling you what stocks are going to, skyrocket and which ones aren't. It's just not going to happen. The industry is full of that junk, and they all ignore the only thing that is going to get you to be a millionaire trader, and that is the money management. That is the compounding. And so if you can take this strategy as an example, and you can average $100 a week with this strategy over the course of 5 years. Well, first of all, over the course of the next 6 months, you're talking about growing a $2,500 account into as much as $32,000. That's huge. But if you were able to average that over the course of a year or 5 years, excuse me, you're talking about growing your account to about $3.4 million. And that's conservatively, and that's pure math. Okay. Now, it may take you a little bit of time to get to $100 a week, right? It may take you a little bit of time, but it is well worth it. By the way, if you can only average $40 a week, I'll show you how to become a millionaire on just $40 a week with these trades. All right, so let's get into the trade that we were trying to take in Friday's call. And if you were here last week, we had all sorts of issues with the weather, screwing up my internet. And so sure enough, I did a call Friday about halfway through. Lightning did that one in. Then Friday, it was supposed to be totally sunny, and it was not. And so what happened is right when the replacement webinar was to start, the storms hit about 15-20 minutes before that. And so I had to record it. But this is what went out at the time. This is the trade that went out. And as of right now, it is the market's moving back down. We were trading at 322.50 about 15 minutes before the call, 15-20 minutes before today's call. And so at the time that this particular trade was pushed out and filled, and this particular one was done on a reverse basis. So I chose to enter the bullish first and then the bearish, and this was filled, and the bullish was actually not filled for about an hour and a half after this, or excuse me, the bearish was not filled for about an hour and a half after this bullish. But this is what we're doing. We're doing a bullish and a bearish trade combined. Sometimes we do them really close together, where the fills are right there, wherever the market is. Other times, like on Thursday and Friday, I was waiting for a better fill on one or the other. So with the reverse one, with the bullish, I said, okay, the market was trading at like 48 cents. And I said, I'm going to buy 2 bullish trades at a debit of 42 cents. It was filled a little bit later. And once it was filled, I placed the order for the bearish to get filled at a credit of 84 cents. And that was filled again about an hour and a half later. There, you could have been filled on both of these at this, by the way, was a credit of 0. You could have been filled on both of these at about a debit of 15 at the same time. So it's only a $15 difference between what I did and what you could have done by getting in both of these at the same time. But you can see here, as of right now, and again, about 30 minutes before the call today, this was trading at about 175, the bearish here, order 1, which is the 84 cent credit. We were filled at 84 cent credit. It was trading at about $1.75. So we're actually losing $90 here. And this one was trading, the bullish was trading as high as $1.18. And right now it's only trading at 94, and then the bearish is trading at $1.44. So 96 now. So if you do the math on that, you're looking at about $100 gain on the bullish, and you're looking at about a $60 loss on the bearish. Earlier, that the difference was about, we're making about $40, $45. Earlier, we were making as much as $60 on this trade. And this is kind of the worst case scenario with this trade. And the reason that it was the worst case scenario is because at the time that we entered this trade, the bearish spread, excuse me, was trading, or excuse me, the market, the underlying market was trading about 4 points below the strike here, the 320 strike. And so this was literally, my bearish neutral trade was literally 4 points, almost 4 points out of the money. And just in a matter of hours, Friday afternoon, market continued to surge. This morning, market continued to surge, and all of a sudden, we were trading at 322.50, and that was kind of a worst case scenario because the market skyrocketed to the upside, literally within hours of us getting filled on this thing. And so, let me show you something here. So this is, let's see if I can increase that. All right, so here's, well, it will, there we go. Here's the bearish neutral trade. Again, this is where it's trading right now. It was trading down here at about 316, 316 and a half. Some of it may have been around 317 by the time you got filled, depending on what time of day it was. And so the market would have had to move, tremendously higher to get up to about 325, which was the projected break even. However, that projected break even with the market moving up, we know it's only going to be around 324, maybe a little bit higher than 324. Nonetheless, we were a long, long way before it hits break even. Of course, an 84-cent credit means the minimum gain on this trade to the downside, even if the market crashes $84. I then, depending on how you put it, I added the bullish trade to it. It was a simplistic bullish trade. It wasn't the best bullish trade, but it was one that I think I felt I had a better chance of getting filled. And in the seminar, I talk about comparing the bullish trades, and I show all of that. And so it's pretty interesting to see how they correlate and how they work together. And basically what we're trying to do with the bullish trades, we're trying to make the most by a certain level with the least amount of risk. And as you'll recall, the break even being at 324, with this particular trade at 324, it's projected to make approximately $276. And this is with two of them. It's not going to make $276 if the market goes to 324. It's probably going to be closer to about, I would say maybe $190 to $200, because the volatility will drop out of these. But you combine these two together, and what I did is I went ahead and dropped the volatility out of those, and this is what you come up with, right? And this is what we've been doing for several weeks now. As many times as we can put this on, there's 1 week where I altered away from that, this particular one, because I was more bullish and I didn't want any risk to the upside. And the reason I was more bullish is because of the July 4th weekend. We ended up creating some dead zones. And there is a dead zone here, but it's not a huge dead zone. And as we've been talking about, the plan on these particular trades is not to hold on until the last day, because there's certain other characteristics behind this. And so what we want to do is we want to give ourselves the highest probability of making money, right? That's the first and foremost thing we want to do. And so with this particular trade, it gives us the ability to potentially make quite a bit more money as it's going through the dead zone, or excuse me, through the profit zone. Right. So in other words, yeah, this particular trade is risking about $100, and that's worst case scenario. If the market skyrockets, about $100. That's a tremendous overall odds on this trade, but it's even better odds when you take into consideration the ability to get out of this trade at a profit at some time before it ever reaches the levels at which you'll start realizing the risk. And on this particular trade, I went ahead and dropped the volatility. As you can see here, I've got it at about 15%. And that's probably going to be pretty realistic going into the close on Friday, which is when this trade expires. Again, I'm probably not going to hold this trade going into the close on Friday because there are too many other opportunities to take profits. One of them being today, just a few hours, just a few trading hours, that is. Obviously, Saturday and Sunday occurred, but there's no market hours, right? So between the time we got filled on this particular trade and the time that the market hit 322 was literally about 4 hours. And so 4 market hours. Okay, so that's why I said this is kind of a worst case scenario, because the market is already moving towards the risk level in a major way compared to where it was at the time we got into the trade. And yet, even with the market now trading down at less than 321, that particular trade has an open position profit. And if you'll recall, I said if you can do $40 a week, if you can do just $40 a week, you can become a millionaire in 5 years with this trade. And so I said I was going to do 98% probability of becoming a millionaire. Well, that's because you have a 98% shot at taking a $40 to $50 overall net gain on this trade, if not more. It may even be a little bit conservative if you're able to get into this particular pattern on a consistent basis. Now, there are some caveats to that. For example, if you get filled on the bearish, but you're not filled on the bullish because you're trying to get a better price, or if you're filled on the bullish, but then you're not filled on the bearish because you went for the cheaper or the lower risk trade first, which is totally fine. You just have to understand where those risks are. But if you really want the probability, then obviously you're gonna need to make sure that you're filled on both of those as quickly as possible. But I'm gonna show you something else here in a little bit to maybe diminish the risks of not getting filled by trading a little bit differently. But if you're able to put this trade on, risk of only $100 to the upside, worst case scenario, and you have a very high probability of making a $40, $50, $60 profit on this trade, no matter what happens, because the market has to go through this profit zone before it ever reaches the risk level. And we're probably not going to hold on till the absolute last minute of the trade because of that. So you're not going to make $150 on this trade. You're not going to make $200 on this trade as a general rule if you are aggressive with taking a profit. All right, and that's fine because there are several things that can be done. And that's kind of where I want to go with today's call based on the current trade and the different options that are available to you. And you don't have to do that. You can just simply take the profit on this trade and be done. There's nothing wrong with that. And literally in 4 hours, you're done for the week if that's what you want. But there are a lot of different opportunities that are available. So let's take a look at what you could do. As an example, you can get rid of this trade, right? Because if you get rid of it, you take your $50 profit, whatever, and you exit this trade, then you have no risk on this trade, right? Well, so that's $50 this week, all right? Then you pull in and you say, okay, what is available? What else is available? Now, to be clear, I did not get out of this trade at a $50 profit. I held on, and that's because we're not anywhere close to the real risk on this trade. And I'll show you something else here in a minute. But if I wanted to be really conservative with how I do this, and try and make at least $50 a week, and that's it, just $50 a week. And by the way, if I do it on this type of trade, I can actually do 2 of these as 1 unit, which I'll talk about here in a second. Okay, so there's a lot that I'm fixing to talk about. So hopefully y'all are taking notes, because you might have to remind me of all the things that I need to talk about. Okay, so nonetheless, so if I were to get rid of that, let's take a look at a couple of different things. All right, I can put on the same trade further away, smaller credit, but same trade further away. So for example, order number 3 here, you'll see here, and I highlight it as order number 3. I put this trade on at a credit of 90 cents about 30 minutes before the market, before this call. It was filled about 30 cents, I'm speaking too fast. It was filled about 30 minutes before this call at a credit of 90 cents, okay? I then placed on the bullish trade, which is what you see here and on order 4, okay? And order 4 bullish trade at the time that I was filled on order number 3 was trading at 65 cents. And since I put the bearish trade on at 90 cents, I put the order to get into this bullish trade at 45 cents, but I only did 1 of them. And the reason I only did 1 of them right now is, and which gives me a credit of 20, is because the probability of the market moving up to 331 is just astronomically small. And so I knew that I will have a very high probability to put on another bullish trade at lower strike prices, maybe at the same price, maybe even cheaper, right? And enhance the trade even more. However, on this one, with the market moving up so much, and I like to do this when the market surges. I like to trade closer to a reversion to the means, right? If I didn't want to do that, if I want to be ultra conservative, which there's nothing wrong with, I could have placed 2 of these at 45 cents. So I have this one at 90 cents, which is essentially the same bearish trade that I just showed you, that we're in, the 320, 323, 324, right? 717, 717, 720. And we got 2 longs, and the longs is 1. The long strike is 1 point above the highest short strike, and the short strike is 3 points above the first short strike, right? That's the pattern. But it was out of the money, which means that as long as I close below about 326, about 326 or 327, I'm guaranteed to make the credit on the trade. And so in this particular example, the market still could move up another 5 points, and I would make $90 on this trade. And by Friday, if I do nothing else. Nonetheless, and we can see here that this is tanked now. I've now been filled on my bullish trade, on my bullish side of this. But look at this. In just a matter of less than an hour, my bearish trade, while I was waiting for my bullish trade to be filled, my bearish trade was making another $40. So you can plan this stuff out, by the way. You don't have to sit here and watch the market. You can put the order in. So what are we in? We are in, I'll show you again. We are in a 320, 323, 324. This one is going to break even at about 324. I can put an order in at the same time if I wanted to and say, okay, I'm going to go 320, 323, and 324. And then I'm going to put on this order. And at the time that I put this order on, it might be trading at a credit of 10. But I'm doing it in preparation so that if the market moves up, I'm going to get into this at, let's say, a credit of 90 cents, which is where I got into this one at, right? About 80. This one was 84 cents. And the reason I did 84 cents on this one is because that's where it was trading and I wanted to get filled. That's where my original one, where I went bearish first, was filled at about 84 to 86 cents on many of them. There was one that I did 90 cents and I was filled on the 90 cents. But it doesn't matter which one you do first or how you do it first. The only question is which one do you want to risk, right? So, excuse me, there is risk on this bearish trade, no question about it. There is risk on this bearish trade, but I just so if I'm in this other one, right? If I'm in this one and I take a $50 profit in this one, and then I get into this one, yeah, there is risk on this trade, but it is a long way away, and I've already taken $50 profit. And if I wanted to, I can try and take a put on a bullish trade. And so it's been a really good day at this point, because what we're doing, and if you've listened to any of my videos, there's two things that you want to be able to take advantage of when you play any option strategy. What are those two things? You want to take advantage of time decay, and what else? Market movement, right? You want to take advantage of time decay and market movement. And if you can take advantage of both of those, then you are putting yourself in a very, 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 very high probability of success with this particular approach. So just like that, even though I've got this trade on now, I've got one bullish trade on. You can already see it's trading now at 42 cents. Again, at the time that this was filled, which was 90 cents when the market was trading about 322.50, and we've already come down in 1 hour. We've come down 2.5 points. This was trading at 65, and I just put it in at 45, and I was willing to wait because of the surge and the probability of the market moving down and how far away the this particular trade was. All right, now, why did I not take the profit on this particular trade when it was trading at a $50 profit, which, by the way, it still is, right? So we're losing $50 here. We're making $80 on the actually losing $40 on the bearish and making about $90 on the bullish, very close to that. Right, so still making $50. I could go ahead and exit this trade again at a $50 profit. It's going to give you this multiple times during the week if the market moves up, if the market moves down, obviously, because if you recall, we were in this particular trade at a credit of 0. So if the market were to crash, we wouldn't make anything on this trade, but we're not risking anything either, right? So you're not going to make, your average is not going to be $50 a week if you take a $50 profit, because there are going to be times when the market moves down and you're not going to make anything on this trade. And so you're going to average those out, and it's not always going to be where you make nothing. Like last week, we made $20, $25 on the trade, even though the market moved down from where we basically got in at. And then if you held on until Friday late afternoon, it actually made a little bit more because the market did surge back into the profit zone. But nonetheless, you're not going to average $50 a week if you take a $50 profit. But you don't have to take a $50 profit on this particular trade. And here is something that is interesting. All right, so we've moved down, and I really wish we hadn't moved down so quickly for the sake of the example, but I'm going to show you anyway. So our bullish trade here, the order number 2. Whoops, this is an active. I don't want to put it on this one. I want to put it on this one. All right, so our $40 trade is this. Let me do this. And I'm going to go. So we are short a 327. Let me add a new order. We are short a 327 and long the 325. That's our bullish. And we're in that trade at a debit of 42 cents. Okay. Now it's only trading at 85 cents. And we're trading, this is now, my bearish neutral is now out of the money again, which is not that one. But it's now out of the money because the first strike is 320, okay? But this is the bullish trade. Now, I want you to see what happens if we go up to 325 today, all right? And how would we do that? How can we mimic that? Well, this would be a 320. All right, so we would do 320, and this would be a 322. And what do you think that's going to be worth a piece? It's going to be worth $1. Let's see if that stays the same. It'll update here in a second. This says right now $1.52. All right, so that means my bullish trade, if the market were to go up to 325, which is where my long is, if the market goes up to 325, this trade should be worth about $1.50. All right, because that's basically at the money, and that's what this one is. It's about $1.50, and it'll probably be worth a little bit more than that because they will drop the value out of these shorts as the market moves up as well. All right, so that means we make $110 a piece, which means we would be making about $220 on the bullish side of this trade. $220 on the bullish side of this trade. All right. All right. So if that's the case, where would our bearish be at? It would be in the money, first of all, right? Because it would be in the money. The long strike would be in the money by about 1 point at that point. So this would be a 319. So what we're going to do is we're going to create the 319, so that'd be a 318, 315. Would be short a 315 and short a 318 and then long 2 319s. All right, and that if you recall, we are short from credit of 84 cents. Okay. As of right now, it's trading at about 226, which means that we would be losing $142 on the bearish trade, and would probably be losing a little bit less than that because as the market moves up, they're going to drop the value of these shorts. And so right now in the money spread, it would be an 84-cent credit is our entry on this bearish, 42-cent debit is the entry on this bullish, and we'd be making about $60, $70 at that point, okay? And that's if it happened today. If it happens tomorrow, we'll probably be making a little bit more, and if it happens the next day, we'd probably be making a little bit more, and if it happened on Thursday, we'd probably be making a little bit more. And so as long as we're not trading up into that range, then I have an opportunity to get out at a profit. And I have an opportunity to get out at a bigger profit than just a $50 gain. If it happened today, I would have about a, did I say 220 to 140? I'd have about a 70, pretty easily a $70 to $80 gain. All right, so for me, what I would rather do is I would rather keep this trade and then put on another trade, which is what I did this morning. The 324, 327, 328, and I did it at 90 cents, and all of a sudden now I have this tremendous trade. My bullish stretch I got filled at 45. But I only did one of them, is now trading at 37, so I'm losing $7 on that one, making $50 on my new bearish, and I'm making about $50 on my original. And that's what I do. All right. That's part of what I do, I should say. So there are all sorts of things that can happen. You know, every now and again, you'll get a situation where you're still in this trade, and this is where the 2% comes in. Every now and again, you'll still get in. You'll be in this trade. Let's say it's the market's at 325, and again, the profit peak is at 327, not 325. The profit peak is at 327. So if the market were to continue higher after 325 to 327, I would be making even more, and I'll show you that here in a second. But if the market goes to 325 today, I could get out and I could take probably about 70% of the profit potential if the market were to stay at 325 through the end of Friday. And so why not? But occasionally the market might pop out of just bounce right over this profit peak. And so, for example, let's say this happens on Wednesday, the market goes to 325, and I decide to hold on for one more day. Even though I can get out of a profit, I can probably get out of a profit at like $70, maybe even a little bit more at that point. If I hold on for one more day and all of a sudden the market opens up the next day at 330, that's where the 2% comes in. That you know, you might be in a situation where you go right over the profit zone. Now remember that the market was trading about 316 on Friday, so we already tried to push to almost 323 today. Didn't work, failed. And so now the market, you know, going up to 330, you know, so it depends on what's going on in the market. I mean, if you put this trade on and the market was down 20 points, then you have a much higher probability of seeing, you know, the market move into this risk level. But you also have a very high probability of being able to exit before it ever gets there. Now, at the time, the 330, by the way, the 330 on this had about a 4% shot as of the close Friday, or no, at the time that we entered in the trade, had about a 4% shot of occurring. So that's 96% probability that the market will be below 330 at the close this Friday. That obviously went up because the market has moved closer to that, or at least it moved closer this morning, and so that increased a little bit. But that's not the whole story. The whole story is, you know, when we get in, are we able to get out of the trade at a profit? All right. So that's one way to look at this, and this is why I focus on this so often, is because sometimes we make it, we get greedy. Sometimes we try and make it more than it is. Sometimes, you know, we try and make a killing every week, and we don't need to make a killing every week. And I just try and say, you know, if all you do is make a little bit of money, that's fine. That's all you need to do, is make a little bit of money every week on a consistent basis and not lose a lot of money. Okay, now on this particular trade, let me get back here. By the way, if I were filled on this, if I were filled on two of these bullish trades instead of just one, where is that? Let's see, order 3 and 4, right? If I was filled on 2 of these bullish trades instead of 1. I have now the same scenario going on if the market goes to 330. So I have a brand new bullish trade. So let's put that in here. By the way, what I'm going to do is I'm going to put that in here, and yep. All right. So this is by 4. We're going to do a brand new one, 324. Add to a new one, 327. And this is the trade that I put on this morning. It's crazy how often the market changes while we're on these calls. 327 and then long to 328. And so I was filled at 90-cent credit. And I don't know exactly what the prices were on that. Doesn't matter. 15, nope, 10. So that's 91. All right. So we'll just change that to 91. That'll be accurate. Then I was filled on 1 bullish, which is a 331, 329. Okay, so short the 331. And I'm going to do that on a different graph so you can see it. And then long the 329s. All right. And I did that at a debit of 45 cents. So and up 3. All right. So there's my bullish. Here's my bearish neutral. So you can see here, the market was trading at 322 at the time. So it has a long way to go before it gets to a break even. And by the way, if it goes up to 325, 326, 327, my original bullish is going to be making the most amount of money. And that's one of the reasons why I only put on 1 of these bearish. If I did 2 of these bearish, I would have no risk to the downside, and I would have a large profit potential to the upside, right? So what I'm going to do is I'm just going to combine these here in trade, not trade partner, PDS trader. So I'll move that one up to graph 7 and move that one up to graph 7. All right, so here is technically the trade that I placed on this morning. And I'm going to give you a better perspective of this because we're not going to go to 335 by Friday. If we do, I'm not going to say I'll eat my hat, but man, I would consider it because I still owe you guys a hat eating. Right, so here is the new trade, total credit of 45 cents. This is not with a drop in volatility. I'm going to drop the volatility, give us a little bit more realistic outlook. And then this one, we're going to go with right there. All right. Now we have a little bit more of a realistic scenario here, and I'll change that to, all right. So basically here, I'm just looking for a high probability. This is with the volatility dropped out, so this is going to be pretty accurate. And again, if I were to hold on to the last minute, which I'm not going to do, or I wouldn't do, a couple of things. I would either take a profit here, let it ride, or I can add another bullish trade for a much cheaper price if the market stays here or even begins to move down. So, you know, as of right now, we have such a low probability of going up to 330 that I would probably just take profits on my bullish trade that I already have and then hold this one. And and let it sit, right? So this one has a little bit higher risk. You're talking about $200 risk because I only did one bullish. I didn't do two bullish. I'll do two bullish here in a second, and I'll show you what that looks like. But I would rather, I have a much higher probability of closing somewhere in this area than I do way up here. Much higher probability. So I'm not worried about this. And if I go all the way up here, I will have already taken profits out of my original trade. And who knows how much, and it would offset this anyway. So low probability, but I'm not over trading. This is the mistake I made 7 weeks ago. We had a similar situation 7 weeks ago, only it was like on Wednesday, and the market had to go, just ridiculously higher, like about where it is right now by Friday. And I said, there's no way that's happening. And I put on a bunch of these trades. I over traded, and sure enough, the market opened up on Friday and or Thursday actually, because of that surprise unemployment report, and I took a nice little hickey right here. Should not have over traded, but that being said, the case, that's not going to happen 98% of the time. You're not going to see that happen. Okay. All right, so what happens if I do two of the bullish instead? If I want to be ultra conservative and I don't want to risk that no matter what, that amount no matter what, you have the same situation where you have this ridiculous looking trade potential where it has to go through another big profit zone. That is with a profit peak now at 331. 331, but look, I have no credit on this trade. I have no credit on this trade. So it's a cost basis of 0. And that cost basis of 0 means that if the market tanks, I don't make anything on this particular trade. And if I didn't get out of my other one, I may not make anything on that trade either if the market were to tank. So I didn't want to do that. I want to make something even if the market tanks. So that's why I put on one bullish. And by the way, I can probably put on another bullish with a 329 short, 327 long. So these two strikes down. Probably put that on for 45 cents at some point during the week if I wanted to. And all of a sudden now I create an even bigger profit peak for less money, by the way. So that kind of gives you an idea of why I did that and what you can do. Now, this I do want to reiterate before I go on to the last thing here. I do want to reiterate on this particular trade. Okay, on this particular trade, I was not filled on this trade. And by the way, if I did the two bullish, I was not filled on two bullish. I only put on one bullish. I want to make sure that you understand that, number one. But number two, I want to make sure you understand that I put on, not that one. Where are we at? I didn't put on this trade at the same time this morning. I'm only in one of these bullish. All right, I'm only in one of these bullish. And it wasn't filled at the time that my bearish neutral trade was filled. So I put on this trade first, and then I waited for a much better price on my bullish in order to get filled on that bullish. And I did get filled on the bullish, but if I didn't, I am risking another 300 and something odd dollars, for almost $400, actually $410, worst case scenario on this bearish trade. So this is not one that you can do necessarily on a smaller account without doing something to hedge the upside. And there are other things that you can do to hedge the upside, which I talk about in the seminar. Don't want to get into that just yet, but I was willing to take this trade without the bullish getting filled because I knew I had a super high probability of the bullish getting filled at some point. I didn't think it'd be an hour later. I figured it might be tomorrow, to be quite frank with you. But it happened on the call today. So that gives you an idea of how that trade came together. All right, final thing that I do want to touch on, and that is, so we're moving back up a little bit. This bullish trade that I talked about, I said it's 158, the market's trading at 320. That is our long strike. The profit peak, the highest profit potential of this trade actually occurs at the short strike, which means this bullish trade, if it represented the bullish trade that we're in, and if the market moved up to the bullish trade that we're in, it could actually move to 327, which would represent the 322 in this one, okay? And just to make sure we're all on the same page, here's my actual bullish trade that I placed on Friday and sent out these signals on Friday, right? So this is the bullish trade. It's a 327 short, 325 long. It's trading at 89 right now, or 90 cents right now. This is the equivalent to this bullish trade right here, and I will click on that one. This bullish trade right here would be equivalent to if the market moved up to 325. Just about 325 right now. It'd be trading at $1.60, right? So we'll be making about $120 a piece, because I am long two of these, $120 a piece. But if the market continues moving up, let's say if it moved up to 327, then that would be equal to a 318, 320. All right, so that would be the short peak. And I say 318. And that one right now, it'll adjust here in a second. Make sure that that's not going to be 296. Yeah, 181. Okay, so if the market continues to move up to 327, I can expect to make about $140 a piece on those longs, on the bullish side, and that's again if it were to happen today. It's not going to happen today. If it happens tomorrow, or if it happens Wednesday, or it happens Thursday, the market moves up to 327. Okay, which is where my short strike is in my bullish side. If the market moves up to 327, this will be trading at least $1.81. All right. So that gives you a perspective on and a process by which you can say, okay, where is this going to be at if the market continues moving up? Where's my trade, my overall trade going to be at if the market continues to move higher? And at $1.82, I am making $280 total on the bullish side of this trade, with a very high probability that the market's either going to stagnate or come back down at that point, because that would be a huge move to the upside. And that's the way these markets work. They move up and then they come off a little bit. Even in bullish area, they move up and then they come off a little bit, and then they move up and then they come off a little bit. Or they move down and then they come back up a little bit, and then they move down and then they come up back up a little bit, et cetera, et cetera. Okay. All right. The seminar I've had a couple of questions on the seminar. I have not sent out, if you signed up for the seminar, I have not sent out a link to attend just yet. And that's because we are considering not doing it through Zoom. We're considering doing it through another webcasting platform, and we'll be making that decision this week. So you will get an email on how to attend probably about 1 week before the seminar begins. And of course, Everybody on this call, if you're on this call right now, you have access to session 1, which I strongly suggest that you go and look at session 1. All right. So I did want to cover that. The other question I had that has come over a couple of times is four-legged trades. Four-legged trades. What can you do with four-legged trades? Well, there are some four-legged trades. You can do three-legged trades. You can do four-legged trades. There are definitely some trades that you can do that you can stay under the $150 risk or very close to the $150 risk and still create a credit and still create a significant probability of gaining a $50 profit or $40 profit or whatever the case is. But the probability isn't, the 98%. The 98% probability is when you set yourself up so that the market has to go through the profit zone first and then allows you to take profits before it ever hits the risk zone. All right, so here's a scenario where that is not necessarily the case. If we were to put on this trade when the market's way down here, then that would be the case. But as of right now, this is one that was available right before the call today, and I don't think it's trading at a credit of 26 anymore. Let's see. I did have it up here, and I'll show you what this is. So this is a 320, 322, 322s, and it's now trading at a credit of only 6 because the market has moved down. It was trading at a credit of 26, and now it's trading only at a credit of 5. So this actually is going through the profit zone underneath it. That's where the profit zone is. All right, so the 320 is the short, 322 is the long, or excuse me, another short at 322, and then the long is at 322 as well. What's the strike difference on this? The total strike difference on this particular trade is only 2 points, right? It's 320 to 322, that's 2, and then 322 to 322, that's 0. So strike difference is 2 points minus a credit of 26 cents, $174 risk. Worst case scenario on this trade to the downside, or to the upside. So very, very, very high probability that you'll stay within the $150 max risk zone, which is, let's see here, right here. Okay, so $150 max risk. That's the money management rule. If you're going to follow this compounding plan, you want to keep your open max risk to only about $150 per unit. And that's a guideline. It's not an absolute. It totally depends on what the probability of realizing that let's say on this one, it's $170. What's the probability of realizing the risk, the $170 risk on this particular trade? Very small, because the market would have to go just absolutely bonkers to the upside. It would definitely be at 330 or above. All right, and we're trading again at the time that this was trading at 26-cent credit, we were trading at 322. So it'd have to go up another 8 points after it's gone up 8 points, literally in about 4 hours. Not impossible, but it can happen. But it's highly unlikely that you're going to suffer a $150 risk on this trade. You're going to have a much higher probability of being able to get out at some sort of profit long before it ever reaches that risk, right? So this is a simple three-legged trade that you can place on that provides you that opportunity. And you can find these or similar ones, by the way, by doing a trade scan and adjusting the strikes just a bit. All right, so here's one of the trade scans that I was doing earlier. And this is, I was looking at the bullish trades to go with my new bearish neutral trade. right? And so you can see here there are plenty of them, but they're so high up. Like the profit peak here on this one, if you look at it, the profit peak here on this one is all the way up at around 337. But this one I would not place on because you can only bring in 7 cents on that 337, which I've gone over that in previous weeks. So I'm not going to go over that one again this week. But nonetheless, you can begin to look at these various opportunities. So for example, let's see, where's one where the risk is smaller to the upside. All right, so here's one. And that'll pull up here in a second. This is one where this one is a debit, right? And this looks like a profit zone, but the market has to go all the way up to the first profit peak is at 329. And the risk on this trade is a little over $100. I would not take a trade like this, right? If I'm going to do something with low risk, or if I want to do something with a single order trade and not try and do 2 orders, I'm going to do something that has a credit, period, end of story. Now, if I were to move these strikes up, I could use this as a pattern, by the way. And if I were to move these strikes down, I should say, I would be able to create a credit with this particular trade. And so I can look at these, and that's something that I can do. Here's also some trades that already have credits, and I wouldn't do these either. And the reason I wouldn't do these either is because in order to create the credit, which is a 14-cent credit on this one, but the break-even level is way, way up there. But overall, in order to create that credit and such a high probability, you are risking, what's the chance of the market going to 340 by this Friday? Virtually non-existent, But in this particular case, this is better than most traders that trade iron condors. I wouldn't take this one, but this is a far better trade than most iron condors that the majority of option traders who trade spreads trade iron condors and certain types of credit spreads. And so, whereas I wouldn't take this one, it is better, right? But you can go through these trade finders and you can look at what's available and then make the make the adjustment so that you have a situation like this where you can you look for a credit. You can also go more bearish, right? You can go something simple like this. You can go we'll go 318, and I'm just doing this at random, right? If it's in the money, it's going to be bearish. 318 short and a 322 long. That's 4 point. And this is when the market was trading at 322. I've not updated these prices yet. Shows a credit of 205, right? Very bearish, much more bearish. The probabilities on this single trade are not that great, but you can do something like a 325 short and a 325 long, right? That's a calendar spread. And you can bump it up a little bit, right? Bump it up a little bit. Now you've increased the probability a little bit more. And this is, you can actually get a better price than what that's showing on those calendar spreads. So you get about 35 cents is what you can get those calendar spreads for. If you wanted to, you could do 3 of these because that will go through a profit zone and you can really buffer up, right? So you're still only risking, worst case scenario, $314 if the market skyrockets to the upside. but you do have a profit peak at this point. It's not going to be that big of a profit peak because the volatility will come out, but you still have a huge credit of 82 cents, and you do have a dead zone here, which is a problem, and you absolutely need to address it, and you can address it by getting out before, right? Because this bearish trade is going to be more profitable if the market moves down a little bit, and that's something that you can take a profit on and basically pay for these calendars, however you want to do it. I don't like this particular setup because the profit peak, the profit zone leads to a bigger, ultimately a bigger risk. I like the smaller risks, but this one has the bigger credit, right? And so the emphasis is on bearish to neutral on this particular trade. But you can do this with one order if you wanted to. It doesn't have to be two orders. Or you can make this a 326. Let's see here, 326. And let's just go ahead and update the prices here and see what this one is trading at. So this one's trading at a 47-cent debit, so I would need to go with a 2. Whoops. All right, and these are one order trades. So here's a 40-cent credit. This one has a dead zone, and this is a pretty steep dead zone, and I've got 3 longs, and my profit potential is only $100. I'm not going to hold on to this one until the close, right? And again, this one, you still have a little bit of risk here, so that's $160 risk. So again, not the best in the world, these 4-legged orders. In the seminar, I am going to give you a series of 4-legged orders that are much better. Again, they're not as good as being able to put together a bearish trade and a bullish trade pattern that you cannot do in just 4 legs. Not as good, but it saves you from the issue of getting filled on one and not the other. Okay, all right. I think I covered the questions that came in from last week. Now I'm going to go ahead and take a look at today's questions. So TPO, can we expect the library TPO trade templates coming out? Yes, there will be several templates, go-to templates that you can use. How does volatility crush affect the profit range in terms of narrowing the break-even point? I've shown that. So, for example, in this particular trade, I dropped the volatility dramatically, showing you the profit potential, or the break-even being at 330 instead of like 332. It just drops it down a bit on this particular pattern setup. Okay. I watch the videos as many times as I can. Each time I watch, I learn something new, and a light comes on, something that I didn't understand all of a sudden makes sense. Excellent, DJ. Glad to hear that. Can you display today's official enhancements again? So I didn't make any enhancements. What I did was I talked about adding another trade. I guess you can call that an enhancement. I talked about adding another trade, right? And what I did was, let's see if it'll update here. What I did was I added this bearish trade, which is a 324, 327, 328, and it's exactly the same trade I put on Friday, only much higher strikes. I did it at a 90-cent credit. And then I added a single bullish, of 45-cent debit bullish. I could have gone with 2 if I wanted to, and I would have created 0 credit. But again, I didn't want to do that. and that was a 331, 329, 331 short, 329. That's the bullish, and this is, if I would have put on 2 bullish, that's what it looks like. I did 1, and so this is, and I did drop the volatility in this one, so that's what that one looks like. So I have again, I've got this one in conjunction with my double bullish trade from Friday, giving me a very high probability of success. All right, let's see here. I'm going to automate the profit taking from bearish neutral. So that's very difficult to do, unfortunately, Keith. It is something that, you know, we're looking at adding it into Trade Partner, but it's very in depth of what has to happen to be able to do that, because there's always the chance that you don't get filled on one of the exits if you put in a limit order. So stay tuned. We are working on that solution. And one of the solutions is just to do it automatically based on the worst case scenario. So once the worst case scenario hits on both of them hits $50, then you can go out at market. We'll have to test that one in case the markets end up not getting nearly as good fills. Let's see. What causes the profit peaks to the right of the lowest profit peak to drop as Friday close approaches? The fact that there's not as much extrinsic value in the shorts as there are in the longs. Anytime you have an inverse extrinsic value situation in your trade, that's when you get a scenario where the profit peak is, or where the volatility drop is going to affect you. Okay, so YM, we were filled on the bullish. If you were not filled on the bullish, I did not prepare for that because we were filled on the bullish. As you can see right here, 42 cents as a 327, 325 filled. So I would, if you weren't filled, I would contact Trade Here and ask them why, or whoever you were with, and ask them why. So if you weren't filled, since we were, I did not even prepare for that. I will do something. And I'll take a look at a couple of things and make a suggestion. But I can tell you right now, the market's trading out at 318.63. So yeah, it's come back quite a bit here. Mike, no, I did not get your email. Send it to Spring, and she'll make sure that it gets to me. Okay, so that's 2 people now that said they didn't get filled on the bullish trade. Okay, so this bullish trade was filled long after I sent the signals out. So it should have had lower priority, unless you placed it on after. It should have had lower priority. This one right here should have had lower priority than anyone that got the signals. So, all right, let's see here. So I will do something on that. All right, let's see. I put in trade for 2 weeks from last Friday. That's why I was around 315. I'm just reading the question here. Charles, I would have traded 2 weeks ago. Spires on 315, credit 104. Today. All right, so 2 weeks from last Friday. So in other words, 324, 327 is what I'm assuming. This is Charles. These are based on the last day of. This is not an open. This is not at all a chart that shows a profit that you're going to incur at any time. If the market moves up, let's say on this one, if the market moves up to 3, and this one I didn't drop the volatility. So let's say on this one, let's say I'm on this one. Market moves up to 327 today. I'm not going to be making $130 on this trade because this is all based on the expiration date, which is 7/17. All right, so you can't look at this chart as if this projection as if it's going to be at any time that the market moves to these levels. If that were the case, we wouldn't be able to put the trade on, right? Because if it's trading it at a 45-cent credit right now, and that means that it would be trading at 0 on the day of expiration, right? So obviously right now doesn't mean I'm going to be making $45 on that trade type of deal. All right, you mentioned the possibility of releasing additional sessions of upcoming TPO. I'm not even gonna, Steve. I'm not gonna make any promises. So I'm not even gonna answer that one. If I come out with it early, if I decide to make them available early, y'all will be the first to know. But that's not an absolute certainty. If you did not receive the trade signals, Scott, your subscription may have ended. So give Spring a call, and how you're attending these calls. If that is the case, I don't know. And if that's not the case, let me put this number up here for you. Then support needs to take care of that for you. All right. All right, so I will be coming out with something for you guys that were not filled on the bullish. There are different bullish trades that you can put on. They're not as good, but they are something where you can at least mitigate the risk. But right now we're trading, my goodness, we're talk about a collapse from the highs today. We are trading at 96 cents on the bearish and 67 on the bullish. So coming down. All right. Let's see if there's any more. You are welcome. Scott, you recently upgraded. Yeah, contact Spring. She will put the hammer down on my support guys to make sure that that they got you on the TPO signal list. Hey, you bet, YM. Appreciate it. Why not change? So why not change the exit date in PDS Trader to see a target value for the exit on Thursday? Because those are never accurate. We use the standard. We use the standard ones. and they're just not accurate on these daily and weekly different spreads. In the new PDS Trader, we are looking at not only changing the equation for the projections, because the models are not geared for the stock index markets, and so we are looking at changing that, as well as making a couple of different variations of it available, as well as creating my own to be more accurate with regard to stock indexes. You're going to show us how to reduce risk on getting both sides filled. Oh, I already answered that. That's to get profit out of the profit zone. I have to wait until Thursday or Friday morning. Charles, send me. You may not have a profit zone. And there are some of these that are not very good profit zones. That produce what looks like a good profit zone that the market has to move through, but there's certain aspects to some of these that are not that great, which I do cover in the seminar. So send me the trade that you have, and I'll make specific comment on it on Thursday's call. All right. Tim, yeah, I know. We have a new version of Trade Partner coming out that takes care of that. Out of curiosity, will we ever be looking at Wednesday, Friday trades? Yes, Carl. We will be looking at Wednesday, Friday trades, also looking at Monday, Wednesday. But that's not the focus, because most of the best prices and the best opportunities for being able to get out at some of these at a profit come on Friday and Monday. But Friday and Monday is also the worst combination for the volatility collapse that comes on Friday, usually Friday afternoon, which creates that dead zone issue. You bet, Charles. All right, thanks, Tim. And all right, looks like I got all the questions. Thank you, Will. Appreciate it. And y'all have a great weekend, rest of the week. And I will see you on Thursday.